Hello, I'm Clara Hermit and this is Breaking the Mould, our regular look at the financial markets with Investment Director Russ Mould. Russ, how are you?
Well, if I was a horse, Clara, my back is so sore I'd be glue by now, but apart from that, I'm absolutely fine, thank you. How are you, more importantly?
I was going to complain about the cold, but after that there's nothing to say.
There you go, stopped
Nothing.
you, didn't I?
Russ, what's the fuss?
Okay, we've got lots of earnings reports coming up, including those from porky product specialist Cranswick and fund management giant Aberdeen Asset Management, that's on November the 30th. And we've got Merlin Entertainment, theme parks on December the 1st. But I'm not sure even these three can cast a spell, Merlin spell, strong enough to persuade investors to ignore a momentous week for macro news, because I think it's this that's surely going to cause all the fuss. We've got useful industrial sentiment surveys on December the 1st, the latest Beige book from America on December the 2nd, and then the big one, the European Central Bank's latest monetary policy statement on Thursday the 3rd.
So there's a lot going on.
There is.
I'm a vegan,
Ah.
so I'm not too bothered about Cranwick's ham sandwiches, to
Fine.
be honest. But why don't you tell me about the sentiment
Okay, so
survey?
ham sandwiches to one side, sentiment surveys. These are compiled by independent data experts designed to take the temperature of the local economy, cover manufacturing, services, construction, and even provide a composite number. And markets like tracking them because they're forward-looking. So they give you a bit of a feel for what might be coming up and how corporations think about the future. This means they're probably more useful than backward-looking data, jobs and employment figures, or concurrent ones like retail sales or industrial production. Stock markets are forward-looking discounting mechanisms that seek to price in the future, and the forward surveys help me get a bit of a feel.
Okay, and the lesson endeth here, I think. What else have we got to look
All right,
at?
I'll shut up then. So Tuesday the 1st of December, Manufacturing Purchasing Managers Index surveys, or PMIs, UK, America and the Eurozone. Services versions come 2 days later. In crude terms, a score above 50 is good, score below 50 is bad, expansion, contraction. Now, as you can see from the graphic here, all three zones stood above 50 in October on the manufacturing front. All well and good, but the American score of 50.1 was the lowest since May 2013, so that's probably the big one to watch. That's particularly the case because, as you can see here, the S&P 500 headline index tends to do well when the manufacturing PMI is going up and less well when it tends to be losing momentum, and there's a gap opened. So a recovery in the US figure potentially provides a bit of reassurance that all's well with the American economy and the stock market.
And the latest Beige book should give us some further pointers here, right?
Yeah, it should. Do you want me to give it its full name?
Yeah,
Go on, let me.
Go
Okay,
on.
the summary of commentary on current economic conditions. Beige book's miles easier. It's published by the US Federal Reserve Board 8 times a year, just ahead of each Monetary Policy Committee meeting. Now, it doesn't feature a lot of hard numbers, lots of anecdotes on how things are doing, banks, restaurants, construction companies, hotter, the same, cooler, simple as that. Now, each Beige book again comes up just before the Fed meets, so Central Bank Chair Janet Yellen and her colleagues will be pouring all over it with great interest ahead of whether they decide to raise interest rates for the first time in 9 years on the 16th of December.
But before the Fed meets, we'll be hearing from the European Central Bank, won't we?
We will. Flexible Mario, Super Mario Draghi, the President of the European Central Bank, latest policy move on December the 3rd. The markets are stone cold convinced we're going to get a further easing, in contrast to the US that's talking about a tightening. Now, Draghi's dropped so many hints it's untrue that he's going to do something, so it's probably a matter of what rather than when. He could cut interest rates again. He could increase the size and length of Europe's quantitative easing or QE programme. It's currently running at about 60 billion euros a month and is due to run to September 2016. Now, he's flagged that he remains worried about inflation, which is hovering around zero. As you can see from the last 12 monthly figures in this chart, there's nothing happening there. Now, European stocks have been rallying quite strongly ahead of Draghi opening his trap because they're convinced he's going to do something, and it's helped boost risk assets like stocks, equities in the US and UK too. However, do note that when Draghi last launched stimulus in March, he talked about it so far in advance that when he actually got round to it, share prices went down and bond yields went up because they'd already priced it all in. So let's see if it happens again. Stocks in the US, UK and Europe and Japan have all tended to respond positively to stimulus or the promise of it, at least in the short term. As you can see here, this is the central bank's balance sheets against the stock market. In America, the UK, and as you can see, they did well when QE was running, but have found it harder to make progress since the end of those programs. Japan here, still at full tilt, infinity and beyond, a bit like Buzz Lightyear, still hammering away. So QE helps the financial economy. Does it help the real economy? Well, I'm not sure, because in the end, if it was working that well, would we really need more and more of it? Just a point, just saying.
Just saying, indeed.
Yeah, just saying.
Thank you very much, Russ.
My pleasure.
And thank you to you for watching. We'll see you next time when we will be fashioning Christmas jumpers. Goodbye.
soon.